Want to know how real estate investors save thousands of dollars in taxes every year by taking depreciation? Let's break it down step by step. So let's say you bought a rental property for $500,000, okay? That's our purchase price, and that's our starting number. And what's really interesting is the calculation is the same regardless of whether you paid all cash for this or if you got bank financing for it. Now, the first thing we need to do is we need to break out land. And the reason for that is because, well, we can't depreciate land. So a question you might have is, how do I figure out what is the land value? I just bought this property for $500,000. There are a couple ways to get land value. One is you can go to the county tax assessor's office and then use the breakout that's shown at the county level. For most counties, you can pull up this information online. Another way to get it is to look at your property appraisal. Typically, if you buy property, especially with loans, you will have an appraisal report. Last but not least, you can also get a land appraisal done if you wanted to get more aggressive. At the end of the day, the goal is to have the lowest land value because then that gives us the highest depreciation. So let's say, for example, that for this property, $100,000 is our land value, which means $400,000 is our total building purchase price, and this is what we can depreciate. Now, if you own residential rental real estate, whether it's a single family home, a duplex, even a multi-family home, typically these are depreciated over 27 and a half years. So we take our number of 400,000, divide by 27 and a half, and that gets our annual depreciation of $14,545. This is a really important number to understand because what that tells us is this is the amount that we can use to offset taxes from our rental income. In other words, the first $14,000 roughly of rental income is not going to be taxed because we have depreciation to offset it. Now, a common question we get from clients is, what kind of real estate should I buy and where should I buy it? If one of your objectives is to maximize your tax depreciation, then one thing to consider is investing in areas where land value is cheaper. So think more in the suburbs or in the mountains and not lakefront, beachfront, where land value is going to be very high. Why is that important? Because like you see here, we have to break out our land value. So you can see, had this been a beachfront property where the land value is $400,000, then that means I only have $100,000 to depreciate rather than $400,000. So the same purchase price of $500,000 on a property does not always result in the same depreciation tax benefit. Now, if you're a real estate investor, you've probably heard people talk about bonus depreciation and accelerated depreciation. If you are someone who could benefit from faster depreciation, then this is absolutely one of the best tax benefits of being a real estate investor. What does accelerated depreciation mean? The IRS says when you buy a property, you don't really know what makes up the building. So traditionally, we just say there's a building for $400,000 and we're going to depreciate that over 27 and a half years. But if you wanted to do even better than that, you can hire an engineering firm to come and break out the components of your building. So instead of saying there's a building for $400,000, you now say, well, this building is actually made up of a lot of different little assets within it. So specialty plumbing or cabinetry or specialty electrical. And when those items are broken out, then your CPA or your tax preparer can help to accelerate that write-off instead of just taking everything over 27 and a half years. So right now with bonus depreciation and accelerated depreciation, a lot of what we're seeing is that you can take maybe up to 30% of that building purchase price in the first year through accelerated depreciation. So in this example, instead of writing off first year depreciation of $14,000, we might be able to get up to $120,000 worth of depreciation. If you're someone in the 50% tax bracket, that is going to save you $60,000 in taxes in that first year. So you can see how powerful it could be if you're using the right strategies. Now, as I said earlier, these numbers are just a hypothetical property. Whether your property will have these numbers or not depends upon what type of property you're investing in, where you are investing, what is the land value, and also what is the opportunity for it to have accelerated depreciation. This is one of the reasons why you don't want to wait until you own real estate to work with your CPA. You want to have your CPA be part of your team even in the acquisition process, because oftentimes your CPA can help you determine the best property from a tax savings perspective. Be sure to hit the like button and subscribe for more real estate tax tips. I'll see you on the next one.